Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to be able to try to help you, have a better retirement. We want to answer your questions. Send them in now. Try to stump us live. That'll be fun. So we do get some questions during the week. You can send them an email. You can send that email now if you want. Send it to AskTom, talkmoneywithtom.com. Or if you're live here with us, you can put it into the chat. We'll try to answer. We got a question right after the show ended last week, so we'll answer that today. But of course, we believe that the more you know about retirement, planning, asset management, tax management, those types of things, whether you're already retired or looking forward to retirement, the better chances you have of having a good retirement, at least financially. And even if you have an advisor, you know what to ask, how to kind of what the language is and those types of things. So you can go to our channel, you can subscribe to the channel, hit the little bell button, get notified whenever we put something new up. And that'll really kind of speed you along, kind of educationally, I think, in that direction. And of course, if you'd like to just talk to us, you can do that also. There's a book appointment button on our website. The link to our website is here on the channel. The button looks just like this. It's up in the corner. Our schedule's live. You can pick a half-hour time to meet with Eason and I, just talk about things that are specific to you. We can do that, in office, phone call, video conference, whatever works best for you. So that would be great to be able to kind of go through all of these things. I'm really hopeful that everybody gets something good at it today. So I always do start off the week with a summary of what we saw happening this week. And so we'll go to our chart. For those of you who've been watching the show, this chart, we've been pulling it up for over a year, basically. And so this is, the beginning of this chart was the high, right? Roughly 4,800 and change on the S&P 500. And then we had all of these giant run-ups, but they kept falling all last year up until October. And turned out October was the low, and the market climbed a wall of worry, right? I mean, Wall Street was expecting really a majority of what I read anyway seemed to be 20-30% farther down. And the reason was because when you raise rates the way that the Federal Reserve is raising rates, it causes all kinds of economic problems. Yep. And usually something breaks. And so 2008, we saw Bear Stearns and Lehman Brothers and such, go out of business. Bear Stearns gets bailed out, Lehman Brothers doesn't. The market dropped 30%. And so this time we had that happen, and actually Silicon Valley Bank and Signature Bank, First Republic, right? All these regional banks almost went out of business, or did go out of business, but it almost caused that big Lehman Brothers moment. And I think it would have. The difference was that, the U.S. at that time didn't bail out Lehman Brothers, and they didn't actually bail out these banks. They just stood behind the depositors. Mm-hmm. And they set up an institution to allow the banks to borrow against the full value of their high quality bonds. And that allowed them to kind of cover this gap, because the bond market had, last year in 2022, the 10-year Treasury had its worst year since 1783.
Yeah, I think the bond market is, at least for Treasuries, it's going to be the third year in a row. It's on pace for a third-year row decline, which hasn't happened in 250 years.
Yeah, and that's tough on the banks, because that's one of the places that they put money, and so if they have money in that, banking system deposits, they might put some of it in bonds. They have to have a certain amount of capital on hand. And the newish rules are that they have to mark to market, which just means that they have to, they used to be able to just say it's $1,000 bond when it comes due, and that's what they put on the books. And then their capital, it could drop to 700. It didn't matter. Well, they changed that. And so all of a sudden it dropped 700. They have to make up that differential in capital. And that, Silicon Valley Bank kind of started this. They were going to try to make up that capital by, sending out new shares, right? Yeah. And that just alerted people, and boom,
spooked the market, and they were gone.
Yeah, and so was several other banks. So, but if you look at this closely, kind of the point this year where we got back to that blue line and kind of challenged that was the point where Silicon Valley Bank went out of business, and we've had this phenomenal run up. And so again, one of my thought processes going forward here has got to be, you have to take a look at what the government's going to do. anywhere in any country because this is becoming a thing. And so China, for the month of August, the first 3 weeks here, really we saw big downturn, and now we've seen this really run up, and it's almost got us all the way back to where we started. And a lot of the talk was, hey, this is falling because of worries of China, and there's a lot going on there that I think is important, especially in their commercial property segment. But there's all week and the last couple of weeks, lots of different new stimulus programs and rate cuts and things that they're trying to do. I think they're a big enough country. Everybody sees the pattern on how to do these things. I would be surprised if it's as big a problem as people think. Basically, the only way it can become a big problem is if China somehow can't do or won't do the types of bailouts that need to. And that's what happened in the U.S. We decided not to bail out Lehman Brothers, didn't realize that it was kind of a house of cards. And that's why they're kind of doing these bailouts now, because I think it was like $7 trillion of cost that ended up, for all the bailouts that came to bail the whole country out versus the $150 billion that was needed to bail out Lehman, right? So this is just some of the history so you kind of understand what's going on. And the market's doing, I think, fantastic this year. We're up, 18, 19%. It's a really good year altogether. We're in a bull market now on an official basis. We're setting new highs that are higher than the previous highs. All the lows that we set are higher than the previous lows. Everything we look at from a classical standpoint for an up market, the 200-day moving average is higher than the 50-day moving average is higher than the 200-day moving average, et cetera. So that's still intact. We talked about, 5-6 weeks ago, the need for a consolidation period, right? It's going too fast, it's pulling too hard. And I really like when it has a consolidation period, because if it really, really pulls and it keeps going another 5, 10, 15%, then sometimes the pullback is so severe, it freaks everybody out. And that's why you get these much bigger downturns. And so this, if you look, the downturn we had here in August is just like the other downturns we've had going all the way up through here. And so things are completely normal so far. Now, they might attach some news to it, whatever that is, but altogether, this is actually a pretty big week. It was a good week for the market, but there was a lot of things reported. And I'll start with one piece, though, to kind of show you what I think is important right now, and that's technology. Big technology is running. And so this is from May 12th. We bought QQQ on May 12th in our portfolio, and I'm cherry picking here. Not all of our purchases work out this well, but I just want to make a point here that, first of all, big technology, it's hard to see these numbers, but up 15.9% for QQQ in the same time period. The S&P 500 is up 9.2. That's a big differential in a fairly short period of time. And I believe that this differential has some room to go, right? Because we have 175 ETFs in our universe, and we look at those. We have different time periods where we're doing a look back, how far back are we looking, and we have kind of a line in the sand, so to speak. So when one of those holdings like QQQ that we have falls below that line, we'll sell it and buy something else. And right now, if you look at that, it's still bubbling up. Now, here's what's really important to understand. Think about May 12th when we bought this. The country was supposedly going to run out of money on June 2nd at that time. They ended up extending that, I think, to June 5th or what have you. But we were in the middle of a debt ceiling argument. I'm getting calls from clients that are worried about what's going to happen, rightfully so. And here we are. We bought QQQ in that time frame, and we actually bought a lot of technology in that time frame because you have to take a look at what the market is telling you. You can't just focus on the predictions and what Warren Buffett's doing, or what the news is saying and what Wall Street is saying. The Wall Street's at that time things are going to fall apart. You can't pay too much attention to what's happening even in the political arena. In this particular case, the markets will tell you. This week the markets were doing really well heading into some unknown numbers, right? The PCE, which we'll talk about in a minute, inflation number was coming out on Thursday. The big jobs report was coming out this morning. The market's going up. And I said on the Tuesday, video that I do on a daily basis, I said, look, the market is going up right now. Let's see if the market is right about these reports. And it mostly is. And my thought process with the market has always been that there are people out there that know what's coming. right? Once in a while, you can see the market get surprised.
Yep.
But if you just pay attention to what the market is saying, and I'm not saying that like everybody knows what they shouldn't know, like insider type information, these government reports. What does happen is that there is huge money. I mean, big trillions of dollars in the market. And some of these big firms have enough resources to kind of put together those government reports.
Yeah, they can kind of make their own analysis.
Yeah, before it comes out. And so that's what you watch for. And so here, technology's popping along in the middle of the debt ceiling argument. And it's worked out great, right? And why was it popping along in the debt ceiling argument? I think partly, at least at the beginning, it was because people were looking for these big companies with big cash flow. If we did have a debt default, maybe the Apples and Microsofts and what have you, the world, survive those better because they have, such huge cash flow, name recognition, and what have you. Eventually, this will morph off into something else that's running, smaller stocks, a value stock. I don't know what it is. But right now, technology's running. We're running with it. I would stick with that for a bit here because we're still seeing that as the piece that's bubbling up. You want to ride the wave to the end. Yeah, I think that wave is not just beginning, but it's still rolling. It's still pretty strong. And now, what you will see, if you look really closely at that chart, during the down period time there, you'll notice that the orange line, which is a QQQ, gets a little bit closer to the S&P 500 because it's a bit more aggressive, right? So in the down market, it's coming down a little bit faster, but we're in an up market. Right, we're in a defined up market, and so that's when you can be a little bit more aggressive. And you got, this is just our target pieces. Most of our money is in these big core things like the S&P 500 and total stock market type indexes. But this is where we kind of make the money on the margins, make up for our fees and hopefully then some, right? And this is where that comes from. So let's take a quick look at kind of what happened this week, because there was a lot of great reports this week that I thought were really important. Because the number one threat, in my opinion, just in my opinion, is not China and it's not a recession. It is a reinflation of inflation, bringing that bubble back up. And you can actually tell that that's the number one threat for the market also. Maybe China's in there too, but because every time we got a report that showed something where things were slowing down, the market went up.
Yep.
If everybody's worried about recession, the market doesn't like to see things slowing down. If everybody's worried about inflation, the market likes to see things slowing down. So here is the number of job openings over the last 3 years. It came down for the month, a fair amount, but it's still at 8.8 million open jobs, right? And if we look at that long term, go back to the beginning of 2000, we're still pretty high.
Yeah.
So to me, that's like the perfect report. You want to see that continue to come down, because bad news in inflationary timeframes is good news, right, for the stock market up to a certain point.
Yep.
If all of a sudden we're way below average, if you look back at 2010, see the number of job openings, the stock market was falling apart back then, right? And so, you don't, and we were in recession, all those things. You don't want it to come too far down, and who knows, maybe this will all go all the way down there. But at the moment, the wave has got to be to the upside because there's still plenty of jobs opening, but the trend is down. And what that does is it just lightens up the pressure on the job market, and it lightens up the pressure on the Fed to raise rates, and all of this comes back to the Fed, right? It's funny to me because I lots of conversations with clients about who's going to be president or Congress or what they're doing, and other than the debt ceiling arguments, honestly, I don't know that it has a massive impact on the overall stock market. The Federal Reserve is the person that I spent, the chairman.
The Fed's looking for a normal labor market.
Yes, yeah, and exactly. And so that came out on Tuesday. That's a pretty good report, in my opinion. That's perfect. And then we had the ADP. This is how many new jobs were created. ADP is a payroll service company. And so how many new signups did they have inside their existing base of clients? These are private companies, and these are sometimes smaller companies also. So 177,000 jobs, 200,000 was expected. So that was seen as a good thing. Market kind of popped on that. But again, if you look at that, going back, it's kind of more in that norm range. It's not real hot, but it's not super cold either. So again, this is part of right at the moment, this soft landing that we're coming in on. And then we had the core PCE index, and I won't bore you with a lot of things here, but this is a really important number. This PCE is the personal consumption expenditure. We've talked about it many times. This is the number that the Federal Reserve is looking at, trying to get this down to 2%. It's not CPI, it's not headline, it is core PCE. And so if you look, it's still at 4.24%.
It went up from previous month.
And it went up from previous year over year,
There you go.
right? And so, but one of the things you got to be careful of is when you're doing a year over year comparison, sometimes you get a weird anomaly the previous year that creates that differential. And so sometimes it's better to look at that month over month. So here's month over month. And, oh, sorry, I didn't put it in there, but month over month was 0.2%,
Yep.
same as the previous month. That's the best 2-month run we've had in PCE core inflation since 21, since early 21. If you look way back on this chart, early 21, inflation was low. Year over year was a 1 point something percent. And if you annualize those 2 months, you'll be at 2.4%.
Which is pretty much where the Fed wants to be.
Yeah, pretty close. Matter of fact, with a little bit fall in between now and next year, you could get to 2%, something next summer type of thing. So we're heading in the right direction. Now, it is, problematic to take 2 months and annualize it out, right? But it's the right trend. It's what we're looking for. It's what the Federal Reserve is looking for. And this again, all of these things that came out this week are going to take pressure off of the Fed.
And the Fed's basically, the market's looking, is the Fed going to raise rates?
Yeah,
That's their big concern.
Right, exactly. And because historically, the Fed has over-raised rates and broken something that couldn't be fixed, and we've ended up in a recession, and some of them have been quite big, and that's what people are worried about. That's it. That's what it comes down to. And so 2008, we had 21 rate increases because of the housing situation, the craziness in the loans that were going on there, and they broke the whole, housing market. And then 2000, we had this irrational exuberance that was happening, and money was being pulled back, and rates were increased 19 times, and we ended up with a 45% drop. 2008 with a 57% drop. Both those times you can make a pretty strong argument that the Fed went too far with their rate increases, and they broke something. So that's what everybody's worried about, rightfully so. So that's why we look at these numbers and say, okay, what's going to happen here, and how's this going to play out? And so here's another one that came out. This was this morning. This is, non-farm payrolls. This is the Department of Labor. This is the big jobs report that comes out that everybody cares about. It was at 187,000 jobs. I believe the consensus estimate was around 177,000.
Yeah, so it's a little bit above, but then they revised previous months down, which kind of...
Yeah, it was just kind of amazing because they actually revised them down like 110,000 jobs. That's a lot. I mean, on a percentage basis, these reports aren't even close to being accurate until later, apparently, because that's not unusual. I keep seeing that. But that's exactly right, because one of the things that, again, if there's too many jobs being created, that means that there is too much pressure in the economy that can create inflation, and that means the Fed starts raising rates, and they can do it too far and they can break. And so, but if you look at this long term, 187, that's a pretty good number.
Yeah, you want your job market to be constantly growing.
Right. Yep.
And the nice thing is when you look at this, there wasn't very much wage increase. There's only 0.2 for the month over month. That's
right. I've got hourly earnings, so 0.2% increase month over month, year over year, 4.29. Yep. But I just wanted to kind of show the trend too. See if you see that, overall trend, the hourly wage is actually coming down. Now, again, if you're a worker or if you care about workers, you want to see it go the opposite direction. If you're an investor and you're in a high inflationary period, you'd like to see this trend. You'd like to see a softening of that back down to something normal. If you look prior to the pandemic, sorry, that's not in here, but the 4%, 3.6, that's kind of a norm. That's usually where it sits. So we're getting closer there. And as Eason mentioned, it actually went up 0.2% for the month, which again, analyzing that out is 2.4%. The market likes this, and the Fed's going to see these same things. And so that's came out this morning as part of the report. And then just the last piece is the labor force participation. And so this is going back, I did 5 years on this, so you could see what happened to pandemic, right? A massive drop off as everybody was laid off, but not really fast coming back, right? But we did have a nice pop here last month, getting back to 62.8%, which is the highest labor force participation rate we've had since February of 2020, so just before like the lockdowns happened. And so what's really important about this is you have high inflation. Most of it is in the service industries. service takes labor for the most part,
Yep.
and you need more people to be working in order to bring down the prices, the increase in prices on services. If you've got lots of waiters and cooks and what have you in your restaurant, you don't have to restrict the supply. If everybody's lined up around the block, they won't be, because you have enough people now, right? Mm-hmm. And so this is a big deal too. There's a lot of good things that happened this week, and the market really hopped over the last 10 days or so. And again, all these reports are pretty good. I think the market kind of knows. Somebody knows. The majority, the big money knows. And you can kind of follow along with the big money by just watching what the market, instead of watching the news so much and the projections from Wall Street and what Warren Buffett's doing or what have you. Just keep watching what the market itself is doing. And at the moment, it's telling us things are okay, right? Yep. That can change, but it has been all year. So that's our report for the week.
What were the signals for the ending signals for the week?
Oh, yeah. Let's talk about the signals real quick too. Forgot about that. So for the stock market signals, we have green for the fast signal. So that means for our, kind of our IRA type assets, the things where we don't have to worry about taxes, which we're not, and we don't have a transaction cost on these ETFs either. So we don't have to worry about, those. That's a faster signal. It'll move from green to red to yellow faster. And so, that basically denotes a big piece of our practice. We have a lot of money in retirement plans. And then yellow is more the taxable accounts. We tend to take that a little slower. We don't want to make as many transactions. And that signal moves slower. It's not too far from green right now. I was just looking at it this morning. And so I wouldn't be surprised if next week or what have you, if the market can just hold up here some, that we don't get to green on that. And then the bond signals, again, we're at green on the short-term signals, again, that we would use for those retirement type accounts, and still at red, because the bond market has been really kind of waffling for the year, as you mentioned earlier. So, but that's, getting better, because it was red, just last week before. So that's hopefully, going to come around. The bond market should be doing better because of the fact that the Federal Reserve is going to have less pressure to raise rates.
Yep.
But it's still struggling, I think, partly because they have to make up for, they have to make up the money that they couldn't get during the debt ceiling argument. From February to June, they couldn't issue new bonds. They're still making up that. And the other thing, of course, the Federal Reserve purchased bonds on the open market called quantitative easing, right, during the pandemic to kind of create liquidity for the overall world, really, but for the market. And then now they're doing quantitative tightening. They're actually letting those bonds fall off, and they're selling some of their bonds also. That creates some pressure on the bond market, and that's going to go on for a while too. So, that's why the bond market doesn't have the same upward pattern that we're seeing in the stock market. I do think there's going to be some opportunity there at some point here because the yields have gotten so competitive.
Yep.
Yeah. So anyway, that's our summary for the week. Look forward to being able to see you again next week, and we'll talk about it then too. So thank you very much, and we'll start with our first questions. What do we have?
So this question came in from last week from John. What are your thoughts on timing of the investment in a silver ETF like SLV?
Yeah. So one thing that's kind of cool now, these ETFs, which they've been around for a while now, but you can buy basically actual silver without buying it. They have the silver on hand, so to speak, that the shares represent, and it's kind of a neat way to do it. Personally, on a long-term basis, I have not used metals. Silver and gold have been asked many times, and one of the reasons is because I back test a lot. I can't make them work better than what I'd use them in a heartbeat if they work better. If they created some diversifier or some higher rate of return for me on a consistent basis.
Yeah.
And so my overall impression of metals, and I could be wrong here, is that the way to make money in metals is the same way you make money on most commodities and currencies, is kind of the trading aspect, right? We do have a visual here. I'll show you just a couple here to show you. So the orange line there is VTI. So VTI is the Vanguard Total Stock Market, index ETF. It's our main measure of the stock market. It includes, 40 600 and some odd stocks now, as most of the U.S. market. And the green line is SLV, which is silver, right? In this particular case, is iShares ETF, and it's a good way to buy silver. But if we look at that from a return standpoint, going back, this is when silver SLV eventually, actually issued in 2006, right? When it started. In that time frame, VTI is up 389% and silver is up 99%. And so obviously we were better off in the stock market since silver came out. Now you can see, though, it's amazing. There's some phenomenal runs there. I think it went from $9 to like $48 in that one run in 2009. Didn't hold up, right? Because it's back down to $22, but still, somebody made some great money in silver, and it runs like that. And you can even see just over my head here, there's a pretty good little spike right there. That was about a 50% spike. So again, on a trading basis, I do have another chart just to show the last 5 years. Basically, VTI and silver ended up in the same spot. So if you put money in either one of them, you'd have made the same amount, give or take, right? But again, from a back testing standpoint, you'd look at that and say, okay, which one had less risk for the same rate of return? The stock market in this case, right? Because it didn't have that huge run up, back down. You can tell it's just not as spiky. Right?
Yeah, and the thing is also, if you're looking for silver as a diversification, how correlated is it to the market? And you can see, like, when the market's going up, silver is also going up, so there's some correlation together.
Yeah.
And so when you're trying to get these different investments that are outside the stock market, you're trying to make something that reduces your risk, or diversifies to reduce your risk while still maintaining those returns.
Yeah. From a strategy standpoint, look at that chart. When would you want to buy that? You want to buy that when it's had some rundowns, right? Look at that huge run up that it had, right? And it came off a low. So buyers come in at some low point. Now, one of the problems is you never know what the low is. And so what I always do is I say, okay, if I had $10,000 to invest and I see it come down to some lower point, which it's really not at right now, right? So I'm not a buyer until I see, what are we at right now? $22, give or take. Looks like they had some lows there, probably in the high teens. So maybe I start accumulating on those lows. I take half of my $10,000 that I would allocate towards this and put that in if it got to some low here. Especially, you can see these two little spikes down that it had just recently. I might put a buy in for a half just below that. Now, it could keep going down and down and down. So, but I'm going to dollar cost average. As it goes down, I might put in another 1,000, put in another 1,000, another 1,000. And so, because if you're going to trade it, if you're going to, not just buy and hold it like we might do with VTI, then you want to be able to kind of buy down on those lows. Hope it has a big run, before you run out of money and putting money into that downward motion. And when it has that big run, if you can get back to a profitable position, start doing the opposite. I might sell half and then, that type of thing. And as it gets these peaks, I would continue selling a portion of that piece. And to me, that's how you play this type of asset. So directly to answer that question, as a diversifier, I wouldn't buy silver. I wouldn't put in a portfolio. As a trading asset, I don't have any real problems with it. I think it has value. It's something that gets used just like gold. There's some usefulness for it. However, maybe I'd be waiting here for a buy point to come in at least below those two lows that we just had over the last month or so.
Yeah, and I'd treat most commodities similar to silver. If you want interested in it and you want to trade it on, but you're going to be monitoring the price, when to buy, when to sell.
Yeah,
it's a lot more timing the market than it is just a long-term hold.
Yeah, exactly. I tend to look at things as to how they fit together inside of a portfolio. How much volatility they have for the rate of return. So for each unit of return that I get from an investment, what risk am I taking for that? And the best investment has the least risk per unit of return if the return is adequate, right? So as I'm looking at these different classifications of investments, that's what I'm looking at. So I love VTI. I think it has a really good return per unit of risk, right? I like the diversification. You own everything. If it's growth or value or small, mid, or large cap, it's in there. It's definitely skewed towards large growth because the whole world is, but because it's capitalized, based on the size of the companies. But nonetheless, those types of things. Right now, I'm buying technology before I'm buying silver, just because I still think that run is still going on. But yeah, it's a good question. I get asked about metals on a regular basis. I haven't used them. I don't have any problem with using them. Long term, though, I mean, if we go backwards, sorry, wrong way. I mean, what does that return in total? 99%. That's not terrible, right? But you actually lost money where you could have put the money. Yeah. I mean, because it was 389% for VTI. That's a huge difference. Yeah. So anyway, good. What's our next question?
Should I prioritize my own retirement or my children's education?
Yeah, I've been asked that. And actually, I think Susie Orman did a whole thing on this where she talked about, making sure you prioritize your retirement savings over your children's education. I'm not sure if she has children. So I have a different opinion than she did personally. But here's the issue. There's a lot of ways to kind of split the difference.
Yeah.
Right. The kids need to go to school. Depends on what school. Right. There's a lot of choices there. Some cost more. Some cost less. There's some option for the child, if needed, to take on debt to do that. Not ideal, but it makes it work. If that means that you still have a decent retirement. So it really comes down to kind of the numbers. I mean, what are we talking about here? You're going to have no retirement savings whatsoever for the entire period that the child goes to college. That's maybe okay. It's 4 years out of your whole lifetime of savings. How much do you already have?
Yeah.
Do you have zero right now and going to have to wait another
Are you
4
behind,
years
you're
to
ahead,
start?
where you need to be?
It's a very personal, question that you'd really want to look at. And that's just, again, I'll talk about this constantly because these type of questions we answer with a financial plan, right? We take Money Guide Pro and we put in the different things. So we try it out. We say, okay, how much impact does it have if we let the child do complete debt for the college and you pay nothing or, very little and put all of your savings towards retirement, or you pay for all of it and maybe delay some of your retirement saving? How much impact does it have? And again, that's the way to answer that question, because unfortunately in today's world, we try to broadcast these answers out to this public, right? And they all have different situations. We see the differences. Again, if I had somebody sitting there with really very little savings, they were 55 or 60 or something, and they were going to retire at 65, and they had a kid or two going to college that was going to eat up all their retirement savings. Wow, that's a totally different scenario than somebody who already has 500,000, a million, 2 million in retirement savings, who now is going to divert some money for 4 years or what have you to pay for college. Is it right? So it depends on the scenario. I have kids that I have paid for their college. Got one more still in. She's almost done next May, and it is expensive. It's kind of a like getting a pay raise when they get out and all that kind of stuff. But I felt like it was my responsibility as a parent to, make sure that was taken care of. I, decided to have children, and with that decision comes all the responsibilities, right? So
it really depends a lot on personal factors. And so like most generic rules will be kind of like an airplane. Always take care of yourself first when the masks come down, and then you take care of everyone else. But if you, depending on, is your retirement savings already taking care of you? Yeah, maybe I diversify and go and help out my children.
Yeah, exactly.
And you can also explore different options. Student loans are an option. You can also take out a loan too. So you can kind of spread it over a longer period of time. You can also see if they qualify for any scholarships. Maybe they go to a different school that they have a scholarship for versus, going to their number one school because of just money factors.
Yeah, exactly. And that, I think it's a great question. It's, it's interesting to, kind of debate it all, but make sure that you kind of understand your scenario, discuss this with us, put it in a plan, see what happens. You'll get the answer. I mean, the real answer instead of, generic answer. But I think that it's a good question. So what do we have for our next question?
So the PCE and jobs report came out this week, and they seem good news for inflation. Why is the Fed president still coming out and saying, inflation's too high, and is this just to talk the market down?
I'm assuming they're talking about the Cleveland Fed president that was talking today, right?
Yeah.
So the PCE's Personal Consumption Expenditure Index, which is the favored measure of inflation from the Fed. And again, it was 0.2% growth month over month, which is considered good, right? So that should get the Fed saying the right things. And then, we have the jobs reports are coming out and they're decent, and wage reports coming out, all these things. And then today, the Cleveland Fed president talking about rates aren't, probably high enough. Inflation's still too high. Probably have to raise rates, and it brought the market down today, at least for a while. While we were just before the show here. So, a couple things to understand. Number one, understand the motivation. So, one of the problems with an upward moving stock market is it is inflationary, right? In lots of different ways. Because we got the consumer spending report, which was the highest it's been, came out yesterday, since January. So consumers are spending. One of the reasons you might spend is because, heck, your accounts are up $100,000 so far this year, or whatever it is, right? So I can go spend $5,000 on this new tool or whatever it is that you might be doing. And so, that's what the Fed has been consistently doing. Now, we're getting less and less impact on the stock market from the Fed. When that first started in November of 21, the market responded pretty aggressively downside.
Yeah.
And really, maybe even all of 2022, you could attach at least some of that motion, that 28% drop, to the rhetoric that the Fed, they were coming out in waves. Once in a while, one Fed governor someplace would say something somewhat positive, but mostly negative. So now the other part is that within the Federal Reserve, there are differences of opinion, right? Some people feel like we don't need to raise rates and, what have you. So it could have been that this Cleveland Fed is just one of those people that feels like rates have to go up and up and up. And there are a couple of them. I think the St. Louis president, Ballard, is very aggressive to wanting to raise rates and such too. There is this understanding that the Federal Reserve in the 70s made a mistake. And they don't want to do the same thing. And I've talked about this several times. Chairman Powell, the Federal Reserve Chairman, has talked about this. And so in the 70s, inflation was jumping up, and they raised rates pretty aggressively, and then it kind of settled down, and then the job market started getting soft enough that they actually lowered rates. And then inflation went nuts. And we got really high inflation, and that's when Volcker came in. And to crack inflation, they raised the Fed funds rate to 19%.
Yeah, they broke the economy.
They broke all of it, and it worked in hindsight. And because we're at 5.25% right now, right? So 19 is unfathomable from where we are. I think there was one period where they raised it 3%, as I recall. We thought 0.75% was a lot. So that's the backstory. All of these Fed governors understand, and none of them want to make that same mistake. Now, unfortunately, they're not talking about the mistake they made in 2000 and 2008 by over-raising rates, and that's what they should be kind of hopefully balancing out the conversation in their own minds between, hey, we don't want to over-raise rates, because the problem with raising rates is that it isn't felt in the economy for kind of 3 to 18 months. So if you raise rates today, you could break the economy next year.
Yeah.
Right. And the market knows that, and it understands that, and it's why it responds fairly negatively as these rates come past where it feels that should be. Market's going up right now. I think the market is okay with where rates are now, but you get up a lot higher, all of a sudden the market will see that what's coming. Right?
Yeah, the market's expecting that rates will hold into at least next year, and so the Fed said they're going to come out with one more price hike or interest rate hike, and so if there's one more hike, at least it's going to be probably a quarter point, and so it'll be pretty small. And then the Fed's basically said they're going to hold rates too. So the
Right.
market's just, which is kind of a good period. When rates are peaking, market's kind of happy.
Yeah, I don't think the market is worried about that quarter point, really. I mean, might see it like today, I moved, but I don't think that's going to be an issue. I think another quarter point if a year from now we're talking about it, and we're still at same rate plus a quarter, there is the higher for longer. There is a period of time that could create, because we are seeing softness, right? We're seeing softness in all of these reports that we just showed today, which is good for the stock market up to a point. If that softness continues, then they're going to have to lower rates. So, we'll see how this plays out. But yeah, I think that they have a vested interest in saying they're going to raise rates because it does disturb the market. And I believe that they're still nervous about where inflation is. And I do think that the biggest threat right now is inflation resurging again. Not maybe to the level it happened in the 70s, but just starting to pick back up again. My gut feel is people are unafraid of anything right now. They're going for it. They're going out, they're traveling, they're spending money. There's a lot of pent-up demand. And there's a lot of money that was saved during the pandemic that's being spent, and people are going into credit card debt, and they're doing what they, sort of
do.
carpe diem, right? I mean, they're living, and you can understand why after what we've been through here. So I feel like there is some threat there. The thing that gives me hope is that the supply is coming on. So if demand is going to grow, if supply can keep up with it, you won't have inflation, or maybe it won't come down, but it won't surge back up, right? And so as we see the job growth coming through, right, and that is what's going to kind of, in my opinion, help that inflationary period, and that's been pretty steady and been pretty good. So far so good. Again, got to look at what the market's telling us. The market is one of the leading economic indicators, and it is going up. It is telling us that things are looking good, both in these economic reports, in the earnings reports from these companies, inside these companies. The market has this information. There is a lot of money in stock market investing, and there are a lot of resources being applied to figuring out what's coming and what's going to happen, and that's reflected, for the most part, in the price. And so just watch the price as it comes, and I think it'll tell you a lot of things, more so than the Fed governor might be able to tell us, right? All right, so that's good for our show today. Got a couple minutes left, but really excited today. Some great questions, actually. So please send them in. Keep them coming. Post them, during the week. Give us a chance that we can make some visuals. Post them, during the show if you'd like. That's always fun. And so look forward to being able to see you again next week. So if you have any questions, send them to asktom@talkmoneywithtom.com. And we'll get on those for the next show, next Friday. And then, of course, if you want to subscribe to the channel, continue your education, hit the subscribe button, hit the little bell button, get notified, when we're going. Hit the like button. That always helps us too, actually. We're trying to build the channel. And then lastly, of course, if you'd like to talk to us, go for the book appointment button, right? And sit down with Ethan and I, and we'll help you with whatever questions you might have. So look forward to seeing you guys all next week, and thank you so much for joining us today.